Financial Services to have the Commissioner for Financial Services, Mairead McGuinness, and also a senior representative of the industry, José Antonio Alvarez, CEO of Santander. We're starting the conversation from a question which I think is very much in the air right now, which is whether we should worry about competitive imbalances in particularly wholesale markets in banking. Clearly, European banks have lost market share over the last decade in that space, and as the European Commission, of course, has to transpose the last bit of Basel III, which is very much on Commissioner McGuinness' agenda, together with other things that we will touch upon. This is we felt at Bruegel a good starting point for this conversation. But since this is the financial services panel of the annual meetings, I'm sure we'll cover a lot more ground. But just to kick us off, Commissioner, what do you think? Should we worry about market shares? Should we dedicate specific policies to this issue? Or is the European Commission just going to transpose Basel III as it has been associated with the negotiations thereof?
Well, first of all, good afternoon, everyone. This vaguely reminds me of my college days, where there was a lot in the back and not quite so many at the front. But it's good to be physically present, and thank you for organising. To come to your point about worry, I mean, we all worry about things, but the most wasted time is spent worrying unless you worry towards a solution. So, of course, we're all concerned about reducing market share. We don't deny that this has happened. We need to understand why, and can we do something about it? So specifically, we tend to compare the US and the EU. And of course, it's good to compare, but it's also good to understand why there are differences. In an ideal world, the European Union is not a baby any longer. It's moving towards and beyond well beyond its teens. Some of the fragmentation that existed in our early years, we would hope would have not quite evaporated, but would have been dealt with. And clearly we're not there yet when it comes to banking union or capital markets union. Specifically to your point then on Basel, as you will have read, I think it's the topic I have received the most lobbying, if that's the word, on, or indeed the most concern from the banking sector in relation to Basel. And we're not only talking about it in terms of the way we are, but the specific place we're in because of COVID. So I think our banks were very much part of solving the initial problems with COVID. So the banks were strong. With government supports, with ECB, we could continue liquidity, so businesses could continue, at least without this deep concern about money at the end of the day. And while there are consequences to that, I think it's important to stress the role of the banking sector in that, and therefore the concerns raised with me. While there are different concerns from different types of banks and indeed different member states, the overall concern is that they're not overly burdened by higher capital limits. And as you know, we have been politically mandated to make sure that that doesn't happen. So we're very conscious of the concerns around the banking sector about how we implement Basel, how we take account of specificities. I spoke about this in my hearing. But equally, that we don't resile from our obligations internationally to implement faithfully Basel, taking into account the flexibilities that are allowed in it. Because I think if we were to pull back, that would give a very wrong signal about the capacity and the strength, or indeed lack of our European banking system. So with all of those caveats, it is our objective to bring forward a proposal very soon in relation to how we will implement Basel III, taking into account those points I have already raised, and trying to accommodate, which is I suppose, the miracle of the European Union, trying to accommodate so many different concerns, and indeed so many political perspectives, both in member states, at government level, at the financial services level, and of course within the European Parliament, where there are equally concerns there voiced, and the voice of the industry comes through very clearly. And there are also those who say don't allow too much flexibility. We must have strong capital base within our banking system. I know we'll go on to talk about the future, and it's really important that we do that. So I think our objective as a commission and our work within the services is to take account of those concerns where we can find within the Basel process flexibility to address them, including timelines, because I think that's another factor and a very important factor. It's a bit like concerns around our support regimes in the member states, which have kept economies and societies and the political system, you know, at least functioning, because if we hadn't done that, it's very, you know, clear that there would have been much different outcomes. So we've managed to keep our communities and our economies functioning, and we don't want a cliff edge when it comes to the withdrawal of supports. Equally, when it comes to implementing Basel, we know what we have to do, but we don't have to do it overnight. We can do this over time with a certainty given to the financial system that this would happen. So that's how I would paint the scenario around our perspectives around Basel, taking into account your overall theme here today, which is, I suppose, weakness versus strength of the financial system. And maybe we will future gaze as well as to the world of the future financial regime rather than simply the banking system. Thank you.
José Antonio, you are leading a leading European bank, but also a global bank. So this trade-off between European optimization and strengthening global standards is something that is part of your daily practice. How do you look at the policy challenge?
Well, naturally, we as a European bank, we apply on a consolidated basis European rules. Yeah, that naturally, for a bank like us that operates in some mature markets comparable to Europe, meaning UK or US, and emerging markets that are not comparable, we face some challenges, that some of them are idiosyncratic to us. And sometimes we do not feel very well represented by the views of the politicians in Brussels, just because we are quite unique in that sense, and nobody thinks what's going on in Brazil or in Mexico and how a rule that applies for Europe may work in Brazil or in Mexico, and we keep trying to raise our voice in order to be heard for this. And as a matter of fact, we are applying naturally the European rules, and this creates a kind of, has a good side, that having the rules, clear rules, it helps us to deal with the local regulators in order to try to follow, to improve, to enhance the rules at the local level, not to catch up, probably catch up is not the right word, yeah? To make them to discuss how to evolve the local regulation in order to better serve the local needs, because naturally their mandate is not Santander, is their local mandate that they need to take care about this. So this is an angle that we have that looking forward, and in the process that we are right now, we have a phenomena that the local and global may become a little bit less clear. We are facing the platforms, and the platforms are not local, they are global, but they compete everywhere. And this is probably the banks. I think we are facing global and local banks, and for us we are facing basically a big transformation in two dimensions. One is a dimension that we've been going around for a couple of years and we are still in the middle, that is digitalization, that changed the very nature of the business and brings new competitors, some of them non-regulated, that we've been saying, oh, we want to have the same activity, the same rules and all these things, and we face this reality. On the other side, a new reality, a new challenge, a new transformation is emerging from the green requirements that apparently put the banks at the center of making this to happen. Yeah? So as a channel to make this happen. So being regulated in Europe is an advantage in the sense that we have an advanced regulation. Not achieving the equivalence with other mature markets or with other emerging markets for us is a problem.
Okay. Which one is the biggest competitive pressure for a bank like Santander in your European activity? Is it foreign banks like US banks coming into wholesale segments, or is it more the new tech-enabled players, whether they're banks or non-banks?
You mean as a threat or as a reality, as a fact today?
Maybe both.
Both. So as a threat, clearly is the tech. People that coming from the tech space, maybe fintechs, maybe big techs, all this space is putting more pressure. and while the rules are not the same and are asymmetric, we share the data, they don't share, all these matters. So this is, looking forward, this is the main threat. Well, the competition from American banks, there's no competition in retail, it's just wholesale space. Yeah? So we have presence in wholesale space, but not as big as the one we have in retail. I will say the problem we have in Europe, in the wholesale market, probably we should talk about the capital markets union. So our capital markets are relatively small and fragmented and not well developed. So if you don't have a home base strong enough to build on top, it's very difficult to compete globally. Okay? The main difference I should say is American banks have a strong, well, the strongest home base with a significant revenues, very good price formation that is not happening in Europe because the market is fragmented. So capital market union, we need to tackle this in order to at least to have the precondition to become competitive vis-a-vis with American banks in the wholesale space. Naturally, we can discuss about regulation, supervision, but this is the precondition, and it's not there. Until this precondition is met, we compete on fragmented markets. So when I look at Santander, we are market leader in Iberia, and we have some presence all across Europe, being second tier compared with the local banks. And Americans play all across the board with a strong home market in the US, and this gives them a significant advantage that we cannot achieve these levels. Yeah?
Commissioner, do you look at the banking sector as one that requires an industrial policy? Do we want to shape the market? How do you look at this question of the interplay between the local players, the American players, the future tech-enabled players? Do you have a kind of mental map of how the system should look like in 5-10 years' time?
I delivered a paper some months back about this, if you like, trying to look to the future, because I think we can get embedded in the past, and perhaps even if you look at the implications of the financial crisis, I think the effect on politics is still there. So there's a caution and there's a concern because banks had to be bailed out effectively. So that when you have that legacy mindset, maybe it doesn't allow you look more strategically to the future. I think I mentioned finance rather than banking. So I think those of us who are old enough, and I'm too old, unfortunately, recall the early days of physical presence and what goes with it. I've just come from Forum Alpbach, where I talked to young leaders, and I mean, they were aghast at the idea of opening a door into any bank physically, or indeed having to come in to sign documents. So in fact, the younger generation are already there, they're ahead of us. Where I see, and immediately I took over this position, where I see real issues is that traditionally individuals trusted their bank to do everything, or at least use their bank to do all of their services. I have 4 children that are in their 20s, and they don't do that. They go elsewhere for different services. So you talked about fragmentation, which I want to come back to in terms of capital markets union. We now are seeing fragmentation at the service level, where banks are no longer holding on to the provision of services, and therefore that has consequences around the profitability issue that we're probably trying to address here today as well. So technology, I think, is the biggest driver of change. I think the COVID crisis has accelerated that rate of change. We were having just a chat before we started about branches. So many branches will close. They closed because of the public health crisis, but they are now firmly closed. So there will not be a decision, I think, in many member states for them to reopen. But already you get concerns amongst vulnerable groups in politics about the implications for communities and societies. And this is, you know, just a fact of life, and it'll be interesting to hear how that is dealt with from a banking and a management point of view. The second issue that arises are jobs in the banking sector. So we are seeing job losses. I would hope that digitalization also would create other jobs so that there isn't just a minus all the way down, but certainly where profitability is low and where costs are being adjusted, everything is looked at. And the third point is going back to digitalization. It costs a lot of money for me to be able to do things that I don't think about the back cost. I just want access to services. And, technology is evolving faster than we can speak. Every day there's a new evolution, there's a new fintech, there's a new idea. I suppose the question for the banking system is, can the banking system buy into these services so that you own them, you possess, you have the brain power, you have the skill set to give all those diversity of services? Or is it inevitable that some of these services drift elsewhere and that banks have to readjust to that? And again, I'm not sure how that readjustment goes. And the truth is, to your question, I have started this conversation internally so that we equally in the services are aware of the many moving parts. We don't have if you like, the end picture, but I think it's important that we look at signposting here. And I think you can only do that by listening to what a younger generation are looking for. To Capital Markets Union, two issues here. When I set out on this journey, everyone wanted Banking Union and Capital Markets Union. So I thought, this is easy. All I have to do is say when. The truth of Europe, and we have to respect the way we are, is that we are 27 member states. And therefore, while everyone wants banking union, what is required of each other to deliver banking union can be very painful for some. So home host, all of these things. And therefore, progress is painfully slow. And it is too slow, frankly. We know that the Eurogroup president had really worked hard to deliver a roadmap, which would have helped the Commission in terms of, going forward. And that hasn't happened. We are hoping that by December that may change, but we're not sure that that is the case. So, there is a need for us all to, those particularly on the political side, to live up to what we are saying we want around banking union. And maybe the way to do that is to have this future conversation which says, look, we don't have much time here. We need to be prepared for the future and not live in the past. Specifically on Capital Markets Union, again, the comparison with the US is really valid, but they come from a market that is not fragmented, whereas ours is fragmented. We've had a discussion previously about pensions. So does Europe have a strong pension pool? And that is not the case. And pensions are politically charged as well. But do we need a Capital Markets Union? We do. Could this green transformation be a driver for stronger capital markets? Because the amount of money needed from the private sector is enormous. And if we are true to our commitment around climate change being real, immediate, damaging and threatening, not just to society, but to the financial system itself, then I think we need to speed up our action on capital markets.
So you mentioned listening to stakeholders and getting input from the broader community, and we want to give a small contributions to that by having a poll, because I understand we have fancy technology that allows us to do that. So there is a poll question on Slido, which is whether the European Commission should prepare a specific policy response if the aggregate share of EU banks in the EU wholesale banking market erodes further. And I understand that anybody who is on Slido, which is our interaction platform for this annual meetings, can at this point vote. Even I can vote, apparently. It's really fancy. We'll get the results later on. I'm not sure how it works, but I think we'll have the voice from heavens informing us of the result at some point. I count on you. Let me take it from there. You mentioned the completion of the banking union, how difficult it is. We've seen that the ECOFIN Council meeting in June has been another episode of deadlock and a kind of disheartening feeling that nothing can make progress because of those interlocked issues of sovereign exposures, of deposit insurance, of crisis management, home host you mentioned, and the usual panoply of interrelated challenges. But the Commission has also started a consultation earlier this year on crisis management and deposit insurance. So can you give us a sense of how you see the sequencing of that? You know that Brussels is always about process and deadlines, and how this is likely to coalesce in the next few months?
I'm going to come to that, but mention this poll that you're doing. It strikes me, maybe because I come from the political space, that we have never spoken to people about what would banking union look like and feel like. So if I were to go out and do a poll today in the streets, and you ask people to describe what would it mean to you, banking union, capital markets union, I think the only answer that we would get some traction on is that maybe I get money at lower interest rates in the member states where interest rates are high. But beyond that, I don't think we have got sufficient political and bottom-up traction as to the importance of these two measures. To your question specifically around timelines and whatever, I suppose because so many of them have been broken, I'm not going to be specific, because I think that is a problem, because every time you say we'll do this by X and then you don't, you set yourself up for failure. I have to say that the president of the Eurogroup was very determined that by last June we would have a roadmap. Now consider that this wasn't an objective of having banking union in place. This was simply setting out a roadmap for progress towards banking union, and that didn't happen because of the many issues that you addressed. And therefore I ask myself rhetorically, so what will change in 6 months to change the view amongst the member states? And thus far I'm not so sure that much will change. On the discussion about crisis management, EDIS, etc., as you know, there is an EDIS proposal out there, an insurance deposit guarantee, but it's not going anywhere. And the challenge for us in the Commission is twofold in a way: to hold to our absolute conviction that capital markets union and banking union in this case, are important objectives, and we want to get there. So we don't let go of that core objective. But equally, we have to make a judgment call about where the space is at the moment. Where is the room for maneuver, given that we know there are different concerns amongst and between member states, and indeed in the European Parliament, while also acknowledging that when you talk to people privately, everyone knows this is something that has to be delivered. So what we will be assessing, and in the next, I said 3 weeks, I'm looking to Tommy, who will either blink at me or not, but we're doing this very soon. We've already had a conversation today before I came to this meeting about the role the Commission can play in this process. Clearly we are the ones that propose. We've already proposed. We've seen what happens. We need to look again. We do need, in this area, we've just discussed the changes that are coming. So today's the banking structure rather of today will not be the one of tomorrow. And therefore there will be banks that will leave the scene, or consolidation. And those that leave, we want it to be, we don't want it to be a difficult parting. We don't want an impact on the citizen and on public finances. We need to have a system that works, so that there is a resolution system that can kick in and is effective. We have a system in place, but it doesn't work for all cases and in all cases. So I think we're still sticking to our view that we need all of these components in order for a banking union to evolve. The question for us now is, can you shuffle the deck of cards in a way that will allow some breathing space for the member states, indeed the Parliament, to see that progress is possible? Some I speak to say we can't do anything unless we have everything. Some say we can do a little if you give a little. So it's a question of trying to get this balance right. So I won't answer you directly with deadlines, but clearly...
Are you in one of those two camps? Everything has to be done in one go, or you can have some low-hanging fruits?
Well, I'm a great believer in practicality and reality. Of course, it would be much easier if we could do it all in one go, because we might save time and energy and a lot of effort. The truth is we may not be able to achieve that because member states and Parliament may decide that they can't do everything in one go. However, this home host issue, some will need some sort of guarantees that if we do step A, that B will come. And C will happen, and that D. So in other words, you can't expect everyone to buy into just one step in what is a multi-step process. So from a practical point of view, it may require us to do a step-by-step approach. From my, impatient political background, and indeed now sometimes, have to reconcile with reality, I would like and prefer that we could have put everything on the table and work on all elements. because we're going to have to do that anyway. And I just would be concerned that, you know, time is of the essence here. We know what we need to do. We've talked it through many times. And therefore, let's get down and do it. And again, maybe because I come from the political space, I'm also conscious that, you know, governments change, attitudes change, society changes. So we have to try and take account of all those moving parts, while being aware, as I future gaze, that, you know, we're perhaps too focused on the regulatory processes and procedures of the past, addressing past issues, without looking to see how long is that going to prevail. Do we want a disorderly change in the financial field or in the banking world, or do we want to have, and this is my responsibility, not just something nice to have, we want financial stability around change, and how do we guarantee that we have that financial stability in a time of great flux and great change?
José Antonio, let's be transparent. One of the key bottlenecks here is sovereign exposures and the regulatory treatment of them, concentrated domestic sovereign exposures in Eurozone banks. And obviously, this is an issue which is unique to a monetary union because in jurisdictions that have their own currency, you have a completely different equation for those kind of things. How much scope for compromise do you see? Do you, as a banker, do you view a possibility in which regulation could lead to some limits on concentrated sovereign exposures without wrecking the whole system? Or do you think it's impossible, as some people seem to believe?
Well, I would not say it's impossible. It's possible, yeah. So depends on the systems, yeah. So naturally there is. Now I think there is less at stake than it was a couple of years ago, significantly less at stake than it was, and mainly because the whole evolution of the whole monetary policy, the ECB jumping in with the buying sovereign bonds and being the main holder of sovereign bonds now in Europe, while in the past probably were the banks. The exposure of the banks towards sovereign is now far more limited than it was in the majority of the countries, and in some of them, given this is more cyclical, given the yields the sovereign bonds offer, this exposure is very, very limited. So I see a possibility to go along with this. The question goes beyond this. Yeah? So the question of now in Europe, the markets, the banking markets are still national. There is no fungibility in capital and liquidity. Till there is no fungibility in capital and liquidity, the markets remain inside the national borders. This is a fact. This is a fact we have. The second fact we have, the profitability is extremely low. And it's low in general, 6% return on equity, if I am not wrong, in Europe, 14% in the US. So that's the case. The prices of financial services are cheaper in Europe than they are in the States. In the States, the NII, the net interest income of the bank, is 2.5%. In Europe, is half of this, is 1.2%. So it's a system, highly fragmented, that provides services or loans or lending at very low cost or a lower cost than American banks, that works in a...
And also, in general, a higher cost structure, right?
Not really when you go to operational side. If you compare with the proper assets, taking into account what happens with Fannie and Freddie and all these things, this is not that much the case. It's pure pricing, and we operate in both sides of the Atlantic, and we know this is a fact. Having said that, the banks, we are fighting to face some of the challenge that the Commissioner mentioned. Digitalization is one. We are not asking for having competitive. We want to compete with the fintechs and with the big techs and with all the others, with the same rules. We are not asking for anything that protects us other than having the same rules than they have. No, this is our purpose, not other than this one. Okay, that's our goal. We are here to compete. We are making efforts to transform ourselves, reducing costs, reducing number of branches, reducing number of people, in order to increase the productivity. But what we face is the reality on the other side is, well, the market is fragmented, is overbanked. We have competitors that are not listed, enough commercial organizations with a return on equity of 1% or 2% is enough, and this creates a dual market. Yeah, so some of them are there to survive, to stay in the business. Some others we have stakeholders that require us to have a clear return on equity. It's true that the banking system is now stronger than it was in the financial crisis with much more capital, but this is the stock.
So
what matters is the flow. So the profitability is very low. If something happens and the banking system needs to attract capital from the shareholders, it's in a very weak position because the profitability is very low. And the prospects for this profitability is limited.
So you agree that the market is overbanked at this point?
Clearly, it's overbanked.
Yeah.
In some jurisdictions, the number of banks depends on the countries. In some countries, it starts to be concentrated, it starts to be about okay. In some others, there is many banks. And many of them are not proper commercial organizations. They are kind of, I don't know, public service, I would say, or something like that, that creates a dual system. And we have this experience in Spain before the crisis. Okay, so having the savings banks on one side, the commercial banks on the other side.
Exactly.
The driver on one side was market share. The driver on the other side was more giving a level of profitability. And profitability in Europe now is the main issue we have. As a system in Europe is this one. So if we don't face this one, and this has many reasons, among others the cyclical ones that are here and will go away, but the structural ones are the ones who matter. The authorities keep telling us, well, go for consolidation. Well, easy to say, very difficult to execute under the current regulation. Yeah? So you go, if I try to do an exercise of consolidation in a cross-border deal, I found that different AML rules, different consumer protection rules, different insolvency law rules. So where the synergy is going to come from?
So you're harmonizing AML, so you're resolving one of the issues here. Are you going to do the same with consumer protection?
But I think you hit on a very important point, that for banks that are trying to operate across border, you have to have literally a department for each member state and sometimes each region. And that's what emerges when you do directives. So, I mean, let's take anti-money laundering. 5 iterations of AML, and we're still not fully implemented on the 5th. We have launched, as you know, the latest proposal, which I hope will give some comfort, if it's implemented in the way we envisage it, where there is a European perspective, so that there is, at that level, clear rules around AML that everybody follows. Equally, we have today very fragmented, to use that ever-worn word, financial investigative units, all doing great things on their own, but not connected. So again, we're trying to address that with this overall authority, this AML. Unfortunately, these things don't happen overnight, so it takes time. And there are, and you probably alluded to some, where other parts of our regulatory process causes some difficulties. But I think that the way around all of these is not to moan that they're there, but to alert us to them and see, can we resolve them? Because while we might want in some areas to move, there may not be the political appetite to do that. I suppose just to kind of ask a question that I don't have an answer to, you've mentioned some of the reasons, the difficulties of consolidation, but I thought that there would be market pressures for consolidation, and despite how difficult it would be, that if profitability is a driving factor, that there would be ways found. And that isn't happening. You are absolutely right that banks are national. The member state I know best, we have seen and are going to see some significant changes. So at the periphery, you may see significant changes where banks are just closing. So, and capital is therefore moving, and there's a reallocation of the actual client base. So it depends on the rate this happens at. And I would have thought that the more we talk, and you've spoken about the low levels of profitability, there is an inevitability around whatever you describe it as, and some people dislike the word consolidation, but there is an inevitability that to provide services, which we'd like to see across border, again, that's what citizens want to see. Roaming charges was a real win for Europe because it resulted in citizens gaining no matter where you were in Europe. And I think banking union, while that isn't the overarching objective, should deliver something that is tangible. But that requires citizens and indeed the body politic to understand what's needed to be done and why cross-border banking is important. And the word that I think we haven't mentioned yet is trust. I think trust was broken between member states during the last crisis. I think trust, citizens' trust in the banking system was fairly well dented. I mean, I don't think it's as bad today as it was, but it's there. And I think trust is a fundamental element of how you make change in the banking system, which will also have political buy-in, because you will get resistance, not everywhere, but in some places towards change. But I still believe that when, and it's before my time, that when banking union was launched, that the whole idea of it is as valid today, perhaps more so than when at the outset, and I would say the same for capital markets union. So, you know, we're not here to say, oh, it's impossible or whatever. We're here to say it's really difficult, but what are the most challenging? What are the least? Where can we start? Equally, a bit like Basel III, that every bank, large and small, that I've spoken to, you know, has a different issue that it wants not to be touched. So how do I persuade some that they're going to have to really give a little that mightn't be very pleasant for them in order for the bigger picture to emerge? Because you mentioned at the very outset, I mean, it was investment banking in particular, where market share is being lost. I mean, you will allow that to continue unless you change. So we have to change the way we are today. And I think digitalization will force the change. I would rather that we at least planned this rather than allow it overwhelm us. And I think maybe the part that is missing is the public pressure for change. It's
right.
not really there.
Adding to the public pressure is our poll. I don't know if we have the results yet, and again, apologies for not seeing the screen. Are the results on screen or no? Anyway, we can get the results of the poll. I'm looking at the technical people. If we don't hear from them, we'll continue the conversation. Okay. So the Commission has a mandate to do some more industrial policy, Commissioner. I don't know whether that's good or bad news. Let's go back to an issue that we managed not to mention too much so far, which is Brexit. So it has happened. The deed is done. But so far there hasn't been so much visible change, actually. So I'd like to get your sense. One of the participants is asking whether there should be some trade-off between concentration of activity inside of a relatively limited number of cities in Europe, financial centers, in order to achieve network advantages, or whether you have a vision of something much more distributed in terms of financial services activities that in the future, because it hasn't happened yet, might migrate from the UK to the EU. How do you look at it in terms of, again, a kind of market vision? And I'll also ask a question to José Antonio on both how he envisages it and what he observes on the ground. But first.
Well, thank you. And there's rarely a conversation without Brexit. But I think increasingly there isn't quite the angst that there was initially, because, you know, we have to move on. You can't bemoan what has happened. You have to accept it. You have to understand the consequences of it. And for me, one of the biggest consequences is that the UK hasn't moved or gone away. It's still very close to us, and we need to have a good relationship with the United Kingdom. Because for the moment...
It's not going too well so far, is it?
Pardon me?
It's not going too well so far, is it?
For whom?
Well, the relationship.
Well, you know, some of the best relationships face choppy times, and indeed one can be strengthened by a lover's tiff on occasion. Look, you know where I come from, physically. And let me tell you where I come from a Commission perspective, because I think it's really important. You have to sometimes allow this public bloodletting or tabloidism or whatever. But, you know, it comes down to those of us who are in the room to make sure we are not overly influenced by all of that. When we look at what are we trying to achieve here? My task, financial stability. When it comes to Brexit, you made a very valid point, and thank you for doing it, that there was no instability on January the 1st. So we prepared well. And this goes back to my earlier observations around the change that's coming. Don't let it happen to you. Prepare for it. But of course, all the questions are not answered around, are there, and maybe I'm asking it and answering it, parts of our financial system which now are in London. When London was part of the European Union, clearly that was great. We had a very strong financial centre, financial infrastructure. What's to worry about? Today it's different. I know that the UK doesn't like being described as a third country, and I find it hard sometimes to say that, but you just have to use the words that are appropriate. And the truth is that the United Kingdom has had quite a severed, decision. They leave the customs market, our single market, and the customs union. So therefore, we are carefully planning, and looking to see what we need to do, not for when the sun is shining, but when the rainy day comes. And I think that's where we have to be very, very measured. So if you take CCPs, we granted equivalence to your point, and that equivalence gives us time to reflect. It also gives certainty to the industry that there was going to be no severe distortion or disruption. But we will, in the coming, let me say months rather than weeks, have to look again at the time horizon here. But we have made no decisions. As you know, we had a working group on this. We are looking at what came from that, always bearing in mind the objective of financial stability. Moving on then to what will be within Europe and how will it look? Will there be one? Will there be three? Will there be four financial centres? Again, digitalisation doesn't require us all to be in the room, but it does require us all to be connected. So that's a key. And already there are some specialisations within the European Union, in particular parts of the financial system. So I think that is likely to prevail and deepen. And in my view, that is a good thing, because it gives us the range of services we need and not just concentrated. But the bigger picture is our relationship globally. We talk about open strategic autonomy, and I think you were referencing that with industrial policy. And I think we've had a bit of a shudder in our minds here, not around yet the financial system in the detail, but around supply of pharmaceuticals. So we're developed, no problem, we can go into our pharmacy and buy what we want, or can we? And we discovered that on one ingredient for the pain in our head, which occasionally comes with talking about banking union and capital markets union, that we might need to actually have a diversified supply. So all of this, and it relates very closely to our work on finance and our work on Brexit, our work on pharmaceuticals, on batteries, is you need to look at your supply chain, and you need to identify your vulnerabilities, and you need to address them. And I think our work before Brexit happened in the financial system, we did that. And I think we did good work, and I think we will continue to work with the sector to understand what we need to do next. There are some who would say, well, it should happen organically, that the system itself should decide it needs to migrate services or whatever, or infrastructure. I'm not so sure. I think sometimes the system needs a nudge. So again, these are issues that we are discussing internally. And as I say, and this is a key point for me, because it's often suggested that everything's fine, why would you do anything? And yeah, that's true, everything's fine today. But when things go wrong, could we guarantee that Europe would be on the same level as the UK if there's a problem? And where do we look after our interests in making sure that we are not overly reliant on any infrastructure for our stability?
José Antonio, from your perspective as a leader of a major financial services firm, and a global one, as you said, has Brexit happened in financial services, or are we still in a state of suspended transition?
It's still in the make, yeah. So it happened from the legal point of view, but in terms of the markets, we advance in some specific parts of the market, like the repo market, and other markets they translate into Europe. Probably the main two things that come to my mind that need to be addressed. One is the equivalence in regulation. We have a subsidiary in the UK, we're in the middle. And so for us it's critical to have equivalence between UK and Europe, the sooner the better. And second is the CCPs, all the derivative markets. The Commission established a deadline 1 year from now. Trading is not translated into Europe as we speak. Only 5% of the trading came to Europe, only 5% 1 year to go. Why? Because efficiency is as simple as that. The markets, the bigger the scale, the better pricing.
You're talking about derivatives markets.
Derivatives
right?
markets. Yeah. That is where the issue, the main issue to me is in these days, because the repo market was relatively easy to transfer to one side, but the derivatives market is much more difficult. Liquidity is more important than in the repo market. The repo market is more commoditized, the other one is less, so liquidity, the less commoditized a market, the more the liquidity is more important. And this is the key issue that is there. Institutions, organically, I don't know if it's going to happen or not, because if you go with if you try to maximize efficiency, you're going to keep going where the liquidity is. You don't have any incentive. You have a negative incentive to go anywhere different than where you were. Okay, so that's the reality, and this is what happened. What happens today? So only 5%. 5% is marginal piece of the market. Going to the other part of this question, when if this is going to happen and it's a question of time, not only. So it's more need to be done. Some kind of incentives. There is not going to be another, in my view, another financial center like London in Europe. It's going to be more split among several cities. There is 3 players there. It's not only about banks, it's also banks, it's asset managers that play a bigger and bigger role and is growing. Financial sponsors that are not regulated, but I don't know how many kinds of financial sponsors that have a big say in the markets, and they are the main operators. Some of the most active players are the financial sponsors, all the private equities, particularly in this world, and where those private equities want to operate, where they are located. So this is going to create a morphology that for sure is going to be different than the one we used to have in London. I used to say, when I was CFO of the bank and was to the roadshow, I spent 5 days in London and probably 1 day somewhere in Europe. That's it. Okay, this represents fairly well the market. 5 days in London, maybe 1 day in Frankfurt or in Paris, maybe. Yeah, this represents fairly well the market at the time. Yeah, is this going to be the case going forward? Probably not. When you go to the States, New York is the center, but you should go also Chicago, LA, San Francisco to see. So probably more this kind of morphology we're going to have in Europe. That's my view. Yeah.
If I may, just on equivalence, because I mean, the issue of equivalence is about today, but we also are aware that things change. And that's why I suppose, in one sense, and it's so long ago, I mean, the UK did grant equivalence in a number of areas, as we did in areas where, you know, clearly we had an interest. And obviously we watch and listen to signals as to how the UK will evolve or where the changes they might make in their regulatory framework, given that they're free from having to work within the EU system. So we're mindful of those things as well, that if you grant equivalence, you have to be sure that that is not a forever, because everything changes, but at least there's a certainty around the equivalence you grant, and that it has a time frame which is reasonable. But again, I think whether you're in Europe, the UK, the US, wherever, there is so much change in my view, and you have more experience, sir, than I do, but you know, anyone watching the financial world, listening to your younger generation, the changes are going to be quite significant, and I think that's where we have to focus our energy and attention on the issues that Europe has been, you know, really pushing: banking union, capital markets union. They are more urgent because of what lies ahead. And therefore, while I have a microphone in my hand to urge our member states, the members of the European Parliament, whom I worked well with, to really take this moment now and push very hard, even if it's difficult, to complete banking union and capital markets union.
We're getting to the end of our session, but you mentioned the sense of urgency, and I think we spent quite a lot of time in this session on banking union and the different obstacles, but I think at least in that area, there is kind of a relatively shared sense now of what needs to be done, even so the political obstacles have not disappeared. Capital Markets Union remains, at least to me, and maybe this is just my lack of understanding, a bit more amorphous, right? I mean, it's been a big vision, and we know what the vision is, but how to get there in terms of policy steps has been, and I think remains more of a challenge. Maybe as a conclusion, if you were to identify one breakthrough that you would want to achieve on Capital Markets Union before the end of this Commission's term, can you inspire us with that?
I could be facetious and say I want to see it completed, because that is the one breakthrough once you complete Capital Markets Union. And it's interesting, I've had some good discussions just this week around, you know, pensions in Europe. We need to talk about pensions and their role in capital markets. But I did mention earlier the Green Deal, this transformation, both the climate, biodiversity, and the digital. And I think in there somewhere, there is a real opportunity for Europe, which is leading in terms of the, you know, our disclosures work, our taxonomy work, that we could perhaps steal a march if we could push for this joint progress on Capital Markets Union. I think there are less political obstacles, maybe I'm wrong, to capital markets than I see with banking union. But there are some, like insolvency, taxation, supervision. So it's not an easy space. But I do pin my hope on this conversation we're having across society, you know, which has really accelerated because people have seen what COVID did to economies, societies, and families, that this sense of urgency around change to address the natural world. And I think when the financial system begins to factor in the risks to itself from these hereto distant issues like the natural world, both in Brazil and in Europe, these are very pressing issues. It will affect balance sheets. Then I think we will see progress.
Mairead McGuinness, José Antonio Alvarez, thank you so much. We started a bit late, but we tried to end more or less on time. This was, to me at least, and I hope for the audience, a conversation that was full of insight and I dare say even wisdom, hoping I don't abuse the word. Our next session is, we have two sessions actually, one at 2:15 on monetary and macroeconomic policies at the crossroads, upstairs on the Galerie de Marbre, and one on the brave new digital industrial policy. I don't know if that includes banking and financial services, here in the auditorium at 2:30. Thank you very much to our speakers, to the audience for this very enlightening session.